Come on, MC. Where's the music?
No music, Jesus. He's gonna hit it, JJ.
What? You want?
You got it, JJ. We're the MC tonight.
Oh, here we go.
This taste is on my mind. Girl, you got me thirsty.
There you go. How's
There
that?
you go. Right on. Awesome.
Late night, that free life chat. Good morning, good afternoon, good evening. How you guys doing? Back here with my DFL pals, James Johnson, Scott Forehand. What's going on, fellas?
Man, we're
Right
just
on, brother.
rocking and rolling, man. Just
Yeah, man.
helping families.
Yep. Families helping businesses.
Saw one today, actually.
Right on. Good stuff.
I appreciate you guys hopping on, being able to definitely help the families and help different business owners with what we've been allowed to present to the masses. You know, the knowledge is only good if it's put to use.
That's right.
Well, let's hop on in. Who have you guys helped? I seen you guys been up and down the roads, back at it again. Who has some interesting cases with debt-free life this week?
Go on,
Well,
JJ.
You want me to go first? Okay.
You hit it.
This is a couple where it was pretty cool. Actually, a friend of mine posted kind of on their job board at work, and this young couple were intrigued by what he put out there as far as helping people get out of debt in 9 years or less, 10 years or less, you know, using the same money that they do now, including their mortgage. And so we got together and we just went through. It wasn't a huge, deal, but this couple, they're a young couple and just had, a couple of $100. And so what we try to tell people is it doesn't matter if it's a couple of $100 or a couple of $1,000. If you'll follow this process, it can just free up and eliminate that debt for you. So, they were working at a place, at a nonprofit organization, and just kind of had several things going on. And you want me to share my screen and we can go through that?
So they saw you from a job board. So you're helping families through friends of friends, which is kudos to you because, that's amazing right there. And you just met up with them to see what you can do. So I'm dying to see what a couple $100 can do with debt-free life.
Well, it's kind of cool because I'll go ahead and share my screen and just kind of go through it a little bit with you. But it's it was an interesting case. As like I said, they were a young couple. They were trying to see what they could do, with the debts that they had, and so let me change this and I can make this a little bit larger. And so when we looked at the debts that they had, not only some, the card debts and the credit card debts, but what was really kind of taking them down was the student loan debts. Student loan debts nowadays, theirs is really nothing in comparison to another lady I saw, which was over $130,000 of student loan debt. And every payment she was making wasn't really going to help her, wasn't really going against the balance. Her statements, every time she'd make a payment, her debt kept going up. So, I said, man, we got to get on this. So, but in this case, like I said, you got the Stafford and Fed thing here and a couple of other things, but then they had these direct debts down here that you see that 50 years, with what they were paying just on this little bit amount here, this $3,000 and $2,900, and what they were making them pay, this $18 and $17 a month, it was going to take them forever, and they really didn't realize that until we kind of got the numbers together and went through it. So, and again, this is, taking a couple of $100 a month. And what we did is we put the numbers in, showed them that the total number of years, they were kind of shocked at 50.5 years. But the total interest paid was $138,000. on their total debt of $185,000. So they're almost paying. It was almost 90% of interest there. So their real debt was $324,000. And so when we plugged these numbers in, we went from 50 years down to 14.4 years. Now it's going to make a difference if somebody's using 200 versus somebody in the same situation if they're using 500 or 1,000 or 2,000. It's just like, common sense is going to tell you that the more you're putting towards your debt elimination, the quicker it's going to happen. But they were super excited with 14.4 years they were going to be out of debt. And look at the interest we saved them, $52,395. So where does that money go? Well, that money is going right back into their pocket because now they're not having to pay that to the lenders. Okay. So it was a huge kind of an aha moment when you pull this out and you go, man, numbers don't lie. Let me just show you how this is going to work for you. So what we did is, a lot of people don't know that money inside of a life insurance contract grows tax deferred. You can pull it out tax free. And so I'm just going to run down here to this other deal here where the page where we talk about the roadmap to success here is we just have them making the same minimum payments on the credit cards and all the things they were doing before. And we have them out of debt in 14.4 years. Now this goes a little bit further because most of the time we come across people who have a residence that's going to not be paid off for 30 years. So this is showing in 50 years what they could potentially have, but still is a pretty big number. But it was really interesting to see how this is going to work. And I'm going to split the screen here so we can kind of have 2 in 1 here and show you. Is it large enough to come through, Scott? Can y'all tell that? Can y'all see the numbers on both sheets? Okay.
No, not really.
Not really. Okay. Well, let me just make this one large enough. So what this one does is it shows that we're using. He was 31 years old. We're using $200 a month. Is that better? Is that better?
Yes.
Okay, there we go. So we're using $200 a month to pay off these debts. See? So in year 2, his cash value is $2,900, but you'll see right here where we come in here and we're going to pull out $1,820 in that second year. So let me flip over to that screen real quick and kind of show you how this puts it in real months and years for people. See where it says 1.58? That's where we're going to take that first $1,820 and move that money. Okay, take that loan out of the policy. And when they take that money out, you'll notice there's not a deduction column over here in this cash value. So when they take out $1,820, they're still earning interest on this $2,980. That's the whole, secret sauce here. Is you're going to always earn on this cash value column because the insurance carrier takes it out of their general fund. They loan you the money, and you're still going to earn interest on your cash value over here, even though you have a loan out against it. It's just as cool gets. But you're able to show people, just like them, what was going to take them. I'm just going to run up here real quick and see their main debts.
50 years.
Yeah, 50 years. But their biggest debts, even 22 years, okay, to get those things paid off in their house, 28 years. Well, look at what happens in all of these things besides their residence. We have them all paid off in 6 years. Even those ones that were going to take them 50 years to get paid off. So it was exciting to me and also exciting to them to sit there and go, man, just using $200 a month, what a difference this can make in somebody's life. It's just a huge accomplishment, and they see it. People can look at this and go, I can follow a 10-year plan. I can follow a 6-year plan. In this case, 14.41 years they're out of debt. But a lot of people have a hard, they don't want to see something that goes, like a mortgage. Oh, you got a 30-year plan? Well, I already do that with my mortgage, right? So the exciting thing about this is this is usually like a 9 or 10-year plan, depending on, again, the amount that somebody's using. But as you can see here, in 8 years, they have most all of their debts paid off except for their residence down there. Everything else is paid off. And they were just shocked. Okay. So it's really pretty amazing because as you see here, there's a little bit of a loan left on year 15. So they pay all that off on year 16. So 16 years versus 50. Needless to say, they were pretty excited about what's going to actually happen for them, right?
I can imagine.
Yeah, it's really cool. They don't have any loans here, so look at somebody age 50 using $200 a month. They have $49,000 cash value in their policy, and again, and $267,000 of death benefit. This is just that's just kind of an added benefit. So it kind of can help take care of protection if they have. Right now, at the moment, they don't have kids, but they're planning on it. So this is actually going to kind of grow for them. Even as they have kids, he's going to be able to have protection for his wife and kids as time goes along. But look at down here even age 55. They could potentially have $70,000 in cash value in his life insurance contract here, $300,000 of death benefit, almost $294,000. But by saving the money after they pay off these debts and they start saving that money, this column right here, this gray column, is showing a 2% growth rate. And so by the time you get down here to age 55, they've got $152,000 that they've saved outside of the policy, but they have no more debts. It's just incredible. And when people see the numbers in black and white and yellow and all the other pretty colors that go along with this, they just are like, man, wow, that is so cool.
I just like the fact, people think that you need so much, you got to have so much to do it, to alter. Can you imagine they're 30-something years old. I'm 30-something years old. $200 doesn't mean much, but it does so much when you put it like this.
Absolutely, it does. Yeah, it's just, and like I said, and you're handing them this outline, and actually they're already ahead of the game because they got a little bit of a Christmas bonus from some family members this past year. They finished paying off the first year's premium, and we actually already took out this $1,820 and already paid off their first debt. So they're already kind of a year ahead of the game from the very beginning. Because I tell people, hey, if something comes in, kind of a little windfall or something, give me a call and let's make sure we're doing this the right way. Because, if they just put it in their bank account and they take it out and just send it off and pay off the lenders, well, now their dollar is not working and doing two jobs for them. It's only doing one again. So I just tell them, hey, anytime something comes in, give me a call. Doesn't take that long to make sure we're doing this the right way. So that's all I had for mine tonight.
Quick 200 from 50 years to 15. Who can beat it?
For real, at $200 a month.
I've never had a 50-year one. I think I would choke. I need a moment to do that one. 50 years.
Yeah. It was crazy. That's the only one. That's the first time I come across a student loan like that was showing that it was going to take them 50 years to pay it off. And it actually surprised them too, because they didn't really know. They just make the payment when the bill comes in. And, and I said, they weren't really looking at the statements. And I said, well, we're going backwards. We're going, every time you're paying in, your balance is increasing instead of decreasing. So, yeah, it was it's a great thing when you're able to help a young couple like that go, man, in 15 years you're out of debt, and they're like, this is the best thing ever. So
Nice. Good job, JJ.
yep, very cool.
Brother.
Mr. Forehand, talk to me.
How you doing tonight, sir?
Man, I'm ecstatic, man. We're just cooling out. The two that taught me the game, just sitting there watching my idols,
JJ taught me, man. JJ was my mentor on this one.
Well, thank you, JJ, because it wasn't for
Thank you, JJ.
You bet, man. Good stuff. More people help, the better off everybody will be.
Sure. Absolutely. All right. Well, I got kind of a fun one to talk about tonight. So this is a gentleman who we've done some work originally with them family for a while back. I'm not ready to show yet.
Oh.
So just want to talk for a minute. So we've done some work with this family a while back, put some IULs in place on their kids and the husband and the wife. So they've got some what I call basically pre-banks already built in. And then we started talking about this debt-free life scenario because the gentleman's a contractor. And he was excited to tell me that he had refinanced his house, which is why we circled back. And in the process of refinancing, he had taken his property taxes out so that he wasn't paying into escrow anymore for his property tax. And also he had taken off his homeowner's insurance. So again, he wasn't paying into escrow for homeowners. He was paying those individually every 6 months. So we started talking about this, and I said, well, what are you doing with the money? And he said, well, I'm taking it, I'm putting it in my savings account until I need it, and I'm pulling it out. It's like, all right, well, I got a better way for you. And then we started talking about his contracting business. And I said, well, how much money do you have set aside for your contracting business? He said, well, some months I make $4 or $5 grand, some months I make 20 grand. So I like to leave a large chunk available for me so I can touch it and use it when I need to as a contractor. And I said, well, how much do you have? He said, I have $60,000 in there. And I said, how much interest are you getting? And he said, I'm getting 0.25%. And there's my tax chihuahua going off in the background. 0.25%.
The attack chihuahua got mad at the 0.25%.
Yes, he did. He knows numbers. So the point of this is he's got a whole bunch of money sitting someplace earning nothing really. He's already made the transition. Instead of letting his lender hold on to money for escrow to pay the taxes and the homeowner's insurance, he's keeping it himself. Same concept as taxes. And then, oh, by the way, I mentioned he's a contractor, 1099. So he's got to pay quarterly taxes. So he does the same thing. So we started looking at all this stuff, and then he doesn't have a whole lot of debts, numbers. He's only got 4 debts, right? But he's got a huge house with a big mortgage on it, and he's got 3 smaller debts. So we looked at this originally from a homeowner's perspective, and looking at, kind of along the same lines as what JJ was looking at. And really it was only like 26, 24 years with that. And it was a small number, but we've got all this money that he's got sitting around that is not working efficiently for him. So here's what we did. So go ahead. Can you see my screen?
Yes, sir.
Okay. So this is the gentleman, and he's a fairly young guy. He's had his business for about 12 years. He's doing pretty well. And we were looking at how much money he's putting aside for taxes, how much money he's putting aside for homeowners, how much money he's putting aside for for his property taxes, and then also a little bit of the money that he's using for overpayments. And it ends up being about $3,800 a month. So I said, well, let's repurpose some of that money. And so that's why we came up with this plan for $2,100. And so basically, this is truly a zero-cost plan for him. So all he's doing is using those other monies that he's spending inefficiently. Didn't add any additional to this. But one of the key things here I wanted to mention is he's got $60,000. So when I structured this vehicle, I made the PUA, the bank loan, the bank capacity for that PUA, I made it so he could dump up to $60,000 a year. So that means every year he can dump 60 grand into this thing. And he I don't know if he will or won't, but if he does, he'll be in great shape. So when we looked at his debt, 24.8 years, and as I mentioned, he doesn't have a whole lot of debts. He's got a car, credit card, he's got a medical bill, he's got his personal residence. That personal residence is big. It's $260,000 in interest he's going to pay in that over time. So when we compared his basic debts, $535,000, but not really, it's $798,000, $800,000 of total debt once you put into consideration the amount of interest he's going to be paying over time. And then we ran his numbers. So remember, these numbers do not include lump sum dump in money. Okay, so when I structured this, we're just looking at $2,100 a month. When we execute this in about 3 weeks, he's actually going to dump in $25,000 immediately. Okay, so these numbers don't include that $25,000 dump in. So this is what we're able to do for this gentleman and his family. 12.1 years. So he went from 24 years to 12.1. But more importantly, we've created this vehicle for him where he's going to be able to do some of the other strategies that we talk about, especially when you get into a business type debt-free life program. This particular family, this is a hybrid. We're only using his family debt as the snowball, but that's because we don't really have to, because he's already got a snowball that's built in simply by taking the homeowner's insurance money that he's spending, the homeowner's the home tax money, the property tax money, and then his 1099 money that he's saving for his income from his business. So here's what happens. We eliminate $79,000 in interest. Not a lot of money. We create $1.3 million in income, or excuse me, in 30 years. He's a young guy. $1.3 million in liquidity, which is great. But moreover, here's the magic, folks. Some of the things that I show my folks is we talk about mortgage chunking, we talk about debt chunking, we talk about chunking of any kind. We also talk about annuity stacking. So this gentleman, even though this is illustrating at 12.4 years, it's not going to be 12.4 years. He's going to have in his first year, we're going to make a single lump sum payment of over $40,000 to his mortgage. We're going to pay off almost 10% of his mortgage in the second year. And then the next year, we're going to pay off another $30,000 on top of whatever he's normally paying. Next year, another $30,000 on top of what he's already paying. And more importantly, the cash value that we see here, again, this does not assume that we're maxing it out. His cash value as illustrated here is only based on what his premiums are going to be at $2,100 a month. We're going to be tacking on an additional $40,000 to $50,000 a year in this cash value column because we built the PUA large enough to capture all that. So when this gentleman retires at age 65 or 60, or I told him he's going to be able to retire at 55 if he wants to, that $258,000 number is way, way, way off. It's going to be at least 15 times an additional $40,000 a year. So it's going to be at least $200,000 plus all that compound interest, all those dividends. And the fact is, when we chunk this mortgage is going to get paid off about 1.5 to 2 years earlier than as illustrated here. So what we're doing is we're rolling all of his taxes in, not only his homeowner's property taxes, but also his personal income tax that he's going to have to pay quarterly. And we're making that money stay up there in that bank and work for him in perpetuity forever. He's never going to, so even when he stops paying that money that he paid in, he's making his tax money work for him. And that's what I love about this plan. I love the fact that we can tell the IRS, okay, I'll pay you, but I'm going to pay you when I want to pay you, as opposed to working this as an employee, where they're taking money out of your paycheck and paying the government, and then you're getting money back every year because you let the government hold on to your money for too long. In this case, we're making our tax money work for us. He's making his homeowner's insurance policy work for him. He's making his property taxes work for him. He's making all those dollars that he's normally spending every year work for him in perpetuity. And that's when you start looking at these plans and how you can come at these from different directions. This is hands down the best way to do it, as far as I've discovered so far.
So you got his home insurance coming out of it.
Yep.
Taxes that he's going to have to pay regardless coming out of his bank. So he's earning money on the taxes that he was going to pay the government anyway.
Yep. Absolutely. And then in the end, he's got this huge lump sum that's growing on an annual basis, that's growing on automatic pilot. He didn't have to do a thing. All he does is keep paying his minimum payment, $2,100, or actually it's much less than that. It's only like $600 for the minimum payment on that plan. And then as long as he stays the course, then the next thing we started talking about this is using those additional solutions. If he gets to the point where he's mortgage chunking, after the mortgage is paid off, it's the same deal. Once you're accustomed to paying a certain thing, what do you do? What do you do then? The mortgage is paid off. He's been accustomed, if he's doing the chunking routine, to paying $40,000 or $30,000 or $40,000 a year extra on his mortgage payment that he's taking out of his bank. So now the mortgage is paid off. What do you do? So we've already gone through this illustration with him about doing one of these daisy chain annuity stacks, and that's what he's going to do. So the first 3 years out, after he completes his mortgage plan, he's going to be doing the daisy chain annuity, and he's going to add 12 annuities. And moreover, there's one more thing I forgot to mention. His wife graduated from medical school. She is waiting to pass the exam. She works as a nurse right now, making $50,000 a year. Her income is going to triple in about 2 years. So what we're waiting for then is probably setting up a separate bank, because this bank's going to get maxed out. He's going to be dumping, certainly $60,000 a year easy into this, and that additional bank for his wife, they're going to have not a 7-figure retirement, but most likely an 8-figure retirement in less than 20 years.
That's pretty cool, man. And, like you said, as a business owner, I don't know what's the states, how they view different things, but in the insurance contract, when all that money's in his bank account, if he has a lawsuit or anything like that, he's not protected. They can get money.
Yep.
If you have that inside this life insurance contract, they can't get that out.
Nope.
So the creditor protection, the life insurance or annuity contracts versus a bank account or IRAs or 401k is a much bigger and better protection for somebody. Yep. And then you talked about, saving him that interest. And I just ran some numbers here, and sometimes we look at it and we go, that's a little piece of it. But when you run the numbers, you go, okay, $79,000 of interest saved at 7% return.
Yes.
Value can be $225,000.
Yes.
So that little thing that we talk about as a small thing,
right,
is really a huge thing to these people.
Absolutely. Yep.
When you look at those two, all these different components together, just really make this thing the hottest thing out there.
Yeah, when I was looking at this, you mentioned you're a $200 person. I did one on $130 last week, right? And the people were saying, "Look, I've got this one debt. It's only $350. It's only $12 a month. Why don't I just pay it off?" I said, "Do, but don't pay it off until we get into the plan, because even $12 a month makes a huge difference in the long term. After you look at 20 or 30 years of compounding, it's crazy, right?" Yeah. So that was my favorite one of the week.
Yeah.
I just delivered my biggest one ever.
Oh, did you?
Oh yeah, 90,000.
All right. Very cool.
So doesn't matter who, but it was my biggest one ever.
Yeah. But that's the cool thing about this, there's a lot of people out there that go, man, I can't afford, who can afford 90? I wish some people go, I wish I made 90,000 a year.
Oh yeah, me too.
And that's fine, but you got to take, the cool thing about this is it can take somebody with $134 a month to 90,000 a year,
right,
and anything in between.
Yep.
So, yeah, it's just really great. I sat down with a couple this week, and she was excited about taking an extra $500 a month and paying towards your mortgage, and I showed them how this is going to work for them. I mean, it gets them out of debt. Not only the mortgage, but their 4 other credit cards and 2 cars.
Yep.
Just barely over 9.7 years or something. And
then the retirement income stream in the end.
Yeah.
There's no downside to this.
No, there's not.
Not that I found.
No, cool as all get. Cool as cool can get, man. It sure is.
Yep. Good stuff.
Awesome, man. Thanks for hopping in. And man, I could just sit back and listen to Debt Free Life conversations all day. But wow.
Yeah, no, we don't went too long. We already went 30 minutes and it shows us
Sorry, I was a little long-winded.
20. But man, when it's that good, you just gotta, people need to know.
They definitely got to know. Well, appreciate you guys. Let's keep at it. Just, we back at it this week. See you guys in a couple weeks. And man, let's continue protecting families and keep it going.
Yes, sir.
Thanks, Javaughn. Appreciate you hosting, man.
Great seeing you guys.
All right.
Thank you.
Y'all have a good one.
See ya.